Okay, guys. So we have seen a couple of concepts in transfer pricing. And the latest one that we saw was with respect to section 92cc and CD corresponding to advance pricing agreements. Now, let us see another interesting concept that was introduced by our finance minister Arun Jaitley during the Finance Act 2017. Before understanding this provision, let us see what was the story that resulted in this provision being enacted. Now, AIPL wants funds of rupees 100 crores. Okay. Now, they are going to go ahead and ask ASPL. Okay. Now, ASPL has two options. They can go ahead and fund equity. Now, what happens because of this? Let us say PBT is 500 crores. Okay, for AIPL, PBT is 500 crores. AIPL. Now, what happens? For ease of understanding, let us assume that tax is 30%. Okay, tax is 30%. So 150 crores will be the tax. And what is the PAT? PAT is going to be 250 crores. Sorry, 350 crores. Now they are making a dividend payout. Here, let us say of the entire 350 crores. So this is option number 1. So what is the dividend that ASPL is receiving? 350 crores. Okay. Now this dividend, when it is received by ASPL, it will be taxed in Singapore. Okay. Now, what is the outcome? Let us tell that India tax rate is 30%, Singapore tax rate is 17%. Okay. So this income right now, what has happened? It has suffered a tax of 30%. And then whatever balance is left over has been granted, and that is again suffered 17% tax. Because of what? Because of choosing the equity model. Now ASPL wants to do something else. They go ahead and give a debt. Okay, so they go ahead and give debt. So they give a loan. So again PBIT, because there is a loan factor here, PBIT is 500 crores. PBIT is 500 crores, and they want to make sure that they get the same 350 crores here. So interest 350 crores. What is the outcome? PBT is 150 crores. Now on this, tax at 30%, which is 45 crores. This is the tax outgo of AIPL. Correct? AIPL has to pay tax of 45 crores. Now what happens to Singapore? Singapore gets 350 crores as interest income. Okay, on that they will have to pay 17 crores. Now what has happened? Because of shifting from equity to debt, the company AIPL has been able to save out 105 crore rupees of tax liability. It has been able to save 105 crores of tax liability. So this is what the MNCs started doing. Okay, so what did they do? They started shifting capitalization from equity to debt. So they started doing what is called as thin capitalization. What is this called as? Thin capitalization. They were preferring debt over equity, so that the tax burden of the international group as such would be lower. Sir, did this happen only in India? No, it happened all around the world. Even developed countries face these issues, and there have been action plans that were brought into place to correct this kind of an action. There were action plans that were brought into correct this kind of an action. Now let us understand what has happened because of this. Tax base. What is tax base? What is the amount available for taxation? Tax base initially was 350 crores under the equity option, and the tax base under the debt option is 150 crores. So what has happened? Base has eroded. What has happened? The tax base has eroded. Why? Because this profit of 200 crores got shifted to the other jurisdiction. So what has happened? This profit, that is this tax liability of 200 crores, 350 crores. 350 crores is the PAT. Sorry guys, small change here. Tax base under the equity is 500, under debt is 150. So this is equity and this is debt. Now what has happened? The base on which tax has to be applied has eroded. The base has eroded to the extent of what? 350 crores. So the taxable base has eroded. Why? Because profits have been shifted. Profits shifted from high tax jurisdiction to a lower tax jurisdiction. So what has happened? The tax burden of the entire group has been made in the lowest manner possible. It has been reduced to the maximum extent possible by doing what? Base erosion and profit shifting. This is a separate topic that you guys will have. Base erosion and profit shifting. The tax base has been eroded because profits have been shifted. Now, the G20 countries and OECD together have laid out certain action plans. So what are G20, what are OECD? Just wait, because there are other topics that will give us some information on these two. That time we can see it in detail. So this G20 and OECD came up with action plans to mitigate base erosion and profit shifting. So action plan number 4. Sir, 1, 2, 3, we will look at it when we come to the topic base erosion, profit shifting. What was this action plan number 4? It was to control the interest cost. It was to have a control over the interest cost. This OECD and G20 started giving some suggestions. So one of the suggestions was that fixed ratio for interest. This was one of the suggestions. So the other suggestions, don't worry about it right now. When we do base erosion and profit shifting, we will look at it at that point in time. One of the suggestions is that G20 and OECD told have a basis for allowability of interest. You have a basis to tell that interest can be allowed only to this extent. So that is a fixed ratio. Have a fixed ratio. Based on that, you allow interest. So this was the suggestion by G20 and OECD. Our finance minister Arun Jaitley took up this suggestion and introduced a new section. He introduced a new section called as section 94B. Now, under this section, he told that interest expenditure will be allowed at the less disallowed portion. So he told that I will consider the interest expenditure and I will remove the disallowed portion to arrive at the allowable expenditure. What will I do? I will take the interest expenditure, remove the disallowed portion or the ineligible portion to arrive at the allowable expenditure. Now, what is the disallowed portion? 30%, sorry, total interest minus 30% of EBITDA or interest to AE, whichever is lower. So what did they tell? Take up your total interest expenditure, AE, non-AE, every interest, associated enterprises, non-associated enterprises, everything you take, that is the total interest. Interest that will be allowable is 30% of EBITDA. What is EBITDA? Earnings before interest, tax, depreciation and amortization. Nothing but operating profit. 30% of operating profit is the allowable interest cost. Okay. Now, if the actual interest exceeds 30% of EBITDA, the portion that exceeds will be disallowed, or the interest to associated enterprises will be disallowed. So let us take a small example to instantly understand. Interest is equal to 200 crores. This is the interest you're showing in P&L. Okay. Now, interest to AE, let us assume that it is 50 crores. Okay. Now, EBITDA, let us take it is 1000 crores. Okay. So, interest 200 crores less interest 200 minus, okay, not 5000. Let us keep it as 500 crores. EBITDA, let us keep it as 500 crores. 200 minus 500 into 30%. And interest to AE, let us keep it as 60 crores. 60 crores. So, interest to AE is 60 crores, total interest is 200 crores, EBITDA is 500 crores. So, total interest is 200 crores, 30% of EBITDA is 150, therefore 50 will be the first disallowance, or interest to AE 60. Lower of the two will be 50. This is the disallowed interest. Interest allowable will be 150 crores. So, what will we do? Take the total interest, which is how much? 200 crores. From that, subtract the lower of the two. What are the two? Total interest minus 30% of EBITDA. Total interest minus 30% of EBITDA, or actual interest paid to associated enterprises. Lower of the two disallow. Okay, so now what has happened? Now this question was raised. Boss, I have actually paid 51. I have actually paid 200. You are allowing only 150. What happens to this balance 50? What happens to this balance 50? This can be carried forward. This can be carried forward for a period of 8 years. So what will happen to this 50? It can be carried forward for a period of 8 years, and it can be set off. It can be carried forward for a period of 8 years and it can be set off. Now, in this we'll have to see who is the borrower, who is the lender. So borrower will be the Indian AE, lender will be NRAE or permanent establishment of the NR in India. So an Indian AE either borrows from a non-resident associated enterprise, or from the permanent establishment of non-resident in India, he takes a borrowing. Then the restriction of interest of 30% will be applicable. Now there might be a doubt. Sir, suppose the non-resident is engaged in the business of banking, provisions will not apply. the non-resident is engaged in the business of banking and he has a PE set up in India, or there is an insurance business which has a PE set up in India, or there is an insurance business giving these loans and advances, then these provisions of section 94B will not be applicable. Okay, and especially when the PE of a non-resident set up in India indulged in banking business gives these loans and advances, it will definitely not apply. Why? Because there is no tax base difference. Both are going to be taxed at the same rate. The interest income of the PE will be taxed in India, and the interest expenditure of the entity is also taxed in India. There is no difference in tax base. There is no evasion here. Therefore, there is no question of application of section 94B. Okay. Now, so this is the next provision that they had clarified. Then these associated enterprises started playing a tricky game. What did they do? ASPL, then let us take HDFC Bank, and then AIPL. These are the three parties. Now ASPL made a deposit of, let us say, 60 crores. Okay, and AIPL takes a loan of 60 crores. Okay, let us say that this is a non-resident bank. Now what did they tell? We have taken it from bank. 94B does not apply to bank, and they are also not my associated enterprises, so there is nothing to be worried about here. Please don't apply 94B for me. This is what AIPL started claiming. Now the tax authorities understood something. This loan was taken after this deposit of 60 crores. So what has happened? In case AIPL fails to pay, they will be supported by this deposit of 60 crores. Correct? So what has happened? ASPL has technically given a guarantee for the loan given by HDFC to AIPL. Therefore, this is an indirect associated enterprises borrowing transaction. This also tantamounts to thin capitalization. Therefore, even such a loan will have the provisions of section 94B applicable. So what has happened? The foreign entity depositing an amount and the Indian entity taking a loan for the same amount, it results in thin capitalization indirectly. Therefore, you will have to apply section 94B. Now, there is an unresolved issue in this regard. Suppose this deposit is going to be for 40 crores. Instead of 60, suppose the deposit is 40. What will happen? There are two views. Okay. One view says that mismatch, therefore 94B is not applicable. Deposit is not equal to borrowings, no 94B. This is one view. The second view that we see from a very aggressive standpoint, or from a very department friendly standpoint, or from a very revenue friendly standpoint, is that 94B will be applicable to the tune of 40 crores. The balance 20 crores will not be covered by 94B. Okay. From an exam point of view, what shall we do, sir? See, you can give an assumption telling that it is assumed that since the borrowings, and you don't have to call it as an assumption, you can specify telling that since the borrowings taken is not equal to the loan, is not equal to the deposit made by the foreign associated enterprises, the provisions of section 194B shall not apply in this regard, and you can leave it. Okay, so that is how you will have to treat this kind of a scenario. Sir, what if we take the other stand? Sir, you can take the other stand, but the computation has to be accordingly done. If there is a problem like that, computation has to be carefully undertaken in such a fashion. When we do one or two problems, you will be able to appreciate it better. Okay, now what happens? Let us take up a problem to understand this particular section. Okay, so that we will see how the application changes. Okay, just look into the handout that has been given. You have a problem there. That problem we will try to take up and solve to get a grip on this topic. Okay, so EBITDA of AIPL. EBITDA of AIPL is how much? 300 crores. Then total interest to P&L. How much is it? 129 crores. And then AE interest paid rupees 51 crores. Okay. So they want us to find out the allowable interest expense. Now, so how do we find out? Total interest expenditure 300 crores less restricted under section 94B. What is the first point? Interest less 30% of EBITDA. Now what is the total interest? Total interest is 129. Sorry, this is total interest expenditure is 129. Total interest is 129. 30% of EBITDA is 90. Correct? So 39 is one of the disallowances. Second disallowance, interest paid to AE. How much is that? 51. So the lower of 39 and 51 shall be considered as a deduction. So disallowance, sorry. So what is going to be the disallowance? 39 will be the disallowance. Therefore, allowable interest expenditure is 90 crores. Okay, so this is the scenario for year 1. Now let's quickly go to year 2. EBITDA of AIPL is going to be 360 crores. And then interest for the year. How much is it? 75 crores. Then interest to AE. Interest to AE is equal to rupees 18 crores. So this is what they have given. Now please understand what happened to this 39 crores. Interest disallowed and carried forward. How much is that? 39 crores. This will be set off over 8 years period. Now the subsequent year, what has happened? This is the scenario. Let us work. Total interest. What is the total interest? 75 crores? No, don't stop there. Not with 75 crores alone. Total interest will be 75 crores of current year plus carried forward interest from the previous year of 39 crores. Plus carried forward interest of 39 crores from the previous years. Both put together 114 crores will be the total interest. So what is the total interest? Current year total interest of 75 crores and the disallowed interest of previous year, which is carried forward to the extent of 39 crores. Fine? Less restricted under section 94B. So what is that? First one, total interest less 30% of EBITDA. Okay, so what is the total interest? 114 minus 360 into 30% is 108. So 4 is one of the disallowance. Then interest to AE, that is 18. Fine. So lower of the two will be 4 crores will be disallowed. Therefore, interest allowed under section 94B will be 110 crores. Interest disallowed carried forward. Okay, how much is that? 4 crores. How many years can this be carried forward? For 7 years, because 1 year it is carried forward and set off. Now the excess leftover will be subsequently carried forward and set off over the remaining period of 7 years. Is this clear? So this is how this problem has to be treated. So quickly going back to the provisions of section 94B, this 94B is nothing but the Indianized adaptation of action plan 4 of BEPS, where the fixed rule ratio was considered. So what is the fixed rule ratio? This fixed rule ratio specifies that some percentage of EBITDA has to be considered as the ceiling limit for the purpose of claiming of interest. So what did we do? We adopted section 94B, where we told that 30% of EBITDA is going to be the ceiling limit for the purpose of claiming of interest. Any interest over and above that will be disallowed, provided that it is not higher than the interest paid to associated enterprises. Now, on top of this, what all did we tell that? We told that if there is going to be a deposit guarantee that is being given for the borrowings to be taken, which is an indirect representation of borrowing from an associated enterprises, still section 94B will be applicable. Otherwise, for insurance and banking business, generally the provisions of section 94B will not be applicable. And also, we understood that provisions of section 94B will not be applicable wherever there is going to be a PE of a non-resident in India which is engaged into the business of banking and insurance. Okay, so with this we conclude on the provisions of section 94B. Now this particular section was tested for the recent examination, okay, and it is also tested a couple of times. So what we will do is, we'll take up 1 or 2 problems in the subsequent classes, and we will try to revisit our understanding on this provision of section 94B. Okay, that's it for now. Thank you guys.